Good morning, dear students. Today we are discussing assessment of partnership. What is partnership? It is the relation between persons who have agreed to share the profits of business carried on by or any of them acting for. The persons who have been entered into the partnership with one another are called individually partners and collectively a firm. So, what is the difference of meaning firm and LLP? Section 223 defines the firm, partner, and the partnership firm. They have interchangeably, we are using these terms under the Indian Partnership Act 1932. The expression partner means also includes any other person who, being a minor, has been admitted to the benefits of an existing partnership. The definition also includes the terms limited liability partnership, a partner of limited liability partnership as they have been defined in the Limited Liability Partnership Act of 2008. So, what is the residential status? It is determined depending upon the fact whether or not the control and management of its affairs is exercised from within India or not. Even if the negligible part of the control and management is exercised from within India, the firm would be resident in India for all the purposes. For determining the residential status of a firm, it is not material to ascertain the residential status of partners thereof because a firm may be resident even in cases where all the partners are not resident in India and they control or manage the affairs from India. A partnership firm, including LLP, is a separate entity in the eyes of Income Tax Department. It is so because the definition of person gives under Section 231 also includes the firm, including LLP. Income earned by firm or LLP is the joint income of the partners, yet such income is taxable as the income of the firm or LLP. A firm LLP is liable to pay tax at a flat rate on normal income as well as on certain special incomes without any basic assumption limit, as in there in the case of individual and HF. So the firm, as defined under the Partnership Act and as defined under the Limited Liability Partnership Act 2008. A firm, though not a legal person or judicial entity, is eligible to tax as a separate entity distinct from the partners, and the partners are accessible as individuals and not as an association of persons or body of individuals. The term the firm as used in the Act covers both registered and the unregistered persons. And what are the features of this assessment of partnership? The first one is it is treated as a separate entity. That means there will be no distinction between registered and unregistered firms. The share of the partner will not be included in the hands of the partner. It will be exempt under Section 10A. Any salary, bonus, commission, or remuneration by whatever name called, which is due to or received by a partner, will be allowed as a deduction subject to certain restrictions. Where a firm pays interest to any partner, the firm can claim deduction of such interest from its total income subject to certain conditions. But the maximum rate at which interest can be allowed to a partner will be 12%. The income of the firm will be taxed at a flat rate of 30% plus surcharge 12% of its total income exceeds 1 crore plus health things and education cess 4%. As for Section 184, the assessment of the partnership firm, the firm is evidenced by an instrument. Individual shares of partners are specified in the instrument. A certified copy of the instrument accompanies the first return of income of a firm. Certified copy of the revised instrument of partnership deed filed along with the return of income is the relevant assessment year. And conditions. Section 184, it should be in writing. The partnership deed should be in writing. It should not be by conduct or oral. The deed may contain the following clauses. That means the name of the firm, place of business, nature of business, date of commencement of business, duration of partnership, capital cost, profit sharing ratio, remuneration payable to partners, interest payable to partners, arbitration clause, drawing power to operate bank account, who is operating for the bank, method of calculation of profit and keeping of books of accounts, management of business, duties of partners, valuation of goodwill, increase of capital of partners, removal or inclusion of partners, and some other clauses as agreed by among the partners. These should be included in the partnership deed. Individual share of partnership must be specified in the deed. The ratio by share partners according to their profit sharing ratio. The profit should be distributed according to the profit sharing ratio. If there is a minor in partnership, how the loss of the firm will be shared among the major partners should be clearly specified in the partnership deed. A certified copy will be submitted with the first return of the firm. The deed would be signed by all the partners. The deed may be submitted by authorized representative along with the authorization letter. In case of any change in the constitution of the firm or profit sharing ratio, remuneration of payment of interest to partners, a revised copy of the deed should be submitted with the return. How they can claim the deductions for remuneration. According to section 40B, remuneration should be payable to working partners only. Remuneration must be authorized by the partnership leader. Remuneration should not pertain to a period prior to partnership leader, and remuneration should not exceed permissible limit. And an individual who is a partner, working partner means an individual who is a partner of the firm. He is actively engaged in conducting the affairs of the business or profession of the firm. To claim deduction of remuneration, it should be sanctioned, approved or directed by the partnership leader or partnership deed should provide power for payment of remuneration to working partners. CBDT, what are the conditions under CBDT? Either the amount payable to the partner should be specified or the manner of quantifying the remuneration should be specified in the partnership deed. And maximum amount permitted by section 40B is the remuneration amount permitted by 40B or the amount remuneration paid or payable to partners as limited to profit and loss account, whichever is lower. And what is book profit and quantum of deduction? On the first 3 lakh of book profit, 1,50,000 or 90% of the book profit, whichever is higher. On the balance of book profit, 60% of book profit. And what is book profit? The first we have to calculate the net profit to take net profit from the profit and loss account for calculating the book profit. Make adjustment that is required to convert the net profit of profit and loss account into the taxable business income shall be applied as provided by section 28 to 44 DB. And remuneration paid to partners if debited to the profit and loss account. Income chargeable under capital gain, income from house property, income from other sources should not be part of book profit. Unabsorbed depreciation will not be deducted, but unabsorbed loss not. Unabsorbed depreciation we can deduct it, but unabsorbed loss we cannot deduct it. Permissible deduction as provided under section 80C to 80U shall be ignored while computing book profit. Then claiming deduction of interest paid or payable to partners. Section 40B, payment of interest should be authorized by the partnership leader. Payment of interest should be pertain to the period of partnership leader, and the rate should not exceed 12% per annum. If the rate exceeds 12% per annum, then an excess amount paid will not be allowed to be deductible. The above portion is not applicable if interest is paid to a person acting otherwise than the representative capacity. And carry forward and set off of loss in case of change in the constitution of the firm. Section 78 contains provisions related to carry forward and set off of loss in case of change in constitution of a partnership firm due to death or retirement of a partner. When a partner goes out of firm by retirement or death, in such a case, the share of loss attributable to the outgoing partner cannot be carried forward by the firm. Restriction of section 78 is applicable only in case of loss and is not applicable in case of adjustment of unabsorbed depreciation, unabsorbed capital expenditure on scientific research or family planning expenditure. Okay, thank you.